Welcome to Investing for Generational Wealth. I'm Keshav Kalor, and I'm joined by my co-host, John Lai from Clive Capital, where we help high earners just like you invest outside the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income, and tax benefits. Together with our investors and our business partners, we are currently renovating over 1,000 apartments and building over 500 single-family home rentals from the ground up. Before we begin, a quick disclaimer: we're not financial advisors. My friend John, my friend Stewart, and I just like to dress up and talk on this podcast. That's it. We have fun. Before we begin, all investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions, and of course, consult your CPA, your attorney, and tax professionals, etc., before beginning investments. And today's episode is the commercial office market is not dead. Today, with that very hot take, is our guest, Stewart. Stewart, glad to have you on the episode today.
Thank you, Keshav. I appreciate it.
Thank you for being here with us today. Could you give us a quick bio, quick background about where you came from, how you got to where you are today?
Yeah, so I'm quite a bit older than both of you guys, maybe both of you combined. So it can take longer to give my bio, but seriously, just short version. Born and raised here in the Mid-South, Birmingham, Nashville area. Sort of been here my whole life. It's a market that I've gotten to know and continue to know fairly well. Became a CPA because my dad was a CPA. It seemed like a good thing at the time, and not really realizing, oh gosh, I'm a lot more entrepreneurial than my dad ever was. So after college, went to work for one of the big 8 firms back when there were still 8 big ones, and realized, gee, I want to do a lot of other things. So then I left there after a few years and started my own firm so that I could go do some of these entrepreneurial things. And eventually, through following some of my clients, through trial and error, just found my way into real estate. And I've known people that have gotten themselves out of huge holes with the IRS by doing real estate fixes and flips, long-term holds and stuff, and generate really kind of some unbelievable profits and pay off debt and all the way to extreme independent wealth by doing things that a lot of other people are not willing to do. I've sort of put my own take on it. I have followed other people's footsteps. I've made a lot of my own mistakes, but I am all about recurring cash flow and the benefits that you just listed in commercial real estate, tax benefits, better average risk weighted returns, and that's really what real estate means to me. And I've sort of put my own CPA spin on that. It's really all about the numbers. Real estate is really very easily a numbers kind of business with a little bit of gut feeling along the way. It's far less complicated than trying to do a tech stock or understanding like that. It's just we're physical beings, and people have to exist in physical spaces, whether that be where they live or where they work or where they shop or where they play. So that's kind of who I am in the short version of what I'm doing now.
Until we get uploaded into the Matrix.
Yes, yeah. I am not going to participate into the virtual real estate world in the metaverse. So
yeah. This topic is a very spicy one. So when you realized that you wanted to transition from being a CPA solely being a CPA to also getting into the real estate world. What was that transition like? Did you have a single family phase? Did you have a multifamily phase? How did you get to office?
Well, yeah, while I was practicing as a CPA, had my own practice, back in the early 2000s, I just started buying up rental houses, duplex here, duplex there. Next thing I knew, I had 30 duplexes, which is 60 units, and and like a traditional business guy, I started looking at reverse integration and realizing how much money I was paying to the property managers. I know what I'll manage this myself, and I started a property management company. It was a that was a pretty bad mistake because there's no margin in management. If you find a great property manager, you need to marry them. But so along the way, I've had my residential phase, and ultimately come along about 2008, had 200 personal rentals. And as I like to tell people, that's the nearest definition of hell on earth that I could ever imagine. I don't enjoy residential management. I don't necessarily like dealing with residential tenants. Residential tenants are not rational many times. And so I sort of migrated into office product because those people are more like my CPA clients along the way. I think net operating income margins are much higher over in the commercial world. I've never done a multifamily. I've developed some, and I did I did buy up all the condos in one development once, and then rented those back out as well as sell them. But that's probably the closest thing I've done to multifamily. I totally respect multifamily as the flagship of all commercial real estate. It's the car that everybody's following. Because residential makes everything else happen for storage, for medical office, for retail. Where the houses go, that's where everything else goes. So I certainly follow that market a lot, but because we manage everything that we sponsor, I, I just shy away from doing multifamily because, as I already said, people aren't rational.
And what do you do? What's your strategy with investing into office buildings right now?
Um, I boiled things down to kind of three basic rules, and then they're not even my rules. I didn't make them up. I just have been doing it so long, I understand what people meant. So, rule number one is all real estate is local. Some people say it's location, 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 um, and it still makes me laugh. I got CNBC on the TV in my office all day long. It's on right now, and three times before 10 o'clock this morning, people had come on and talk about office is dead, office is dead, office is what is it? Warren Buffett says that when people are afraid, be greedy. The financial media is sowing generalized information into the market, and unless you're following it, you think, oh, okay, office must be dead. While they're driving the office, they think office is dead. Well, none of my tenants have apparently heard that. So because they're all happy and paying their rent. But everything comes back to the local community. And when I say local, the hyper local. So our first deal that we did as Harvard Grace Capital was a suburban office building. I had managed it for several years before we closed it. We still manage it now. It was full before. It's full throughout the pandemic. It's full now. And I wish I had three more just like it, because in a 10-mile radius around that building, there ain't nothing like it. I could fill three more buildings if we could pull that off and make that happen. Price of land gets in the way. So this is a suburb of Nashville called Spring Hill. And so what's different about that office building and the ones that are supposedly dead? I have boiled it down to this. if your property has tenants that are consumer facing, that's where they meet their customers. You're okay. You're good. It's the downtown office. It's the Class A office parks that are in suburbs around big cities. That's where the employees don't want to go anymore, and that's not generally where they see their customers. Those are just really nice high-end properties with marble floors and marble bathrooms, and they're Class A properties. Um, and those are the ones that are having trouble. We're not pursuing any of those, not until any of this shakes out. And I think it's going to be fine because you do see a big pushback from employers are saying, you're coming back to the office at least some of the time. Well, if you want them in 2 days a week or 3 days a week, you still got to have space 7 days a week for them to be there. So I think in most markets, the office market is going to be fine. But when you get out beyond the Class A places, most office that I know is fine. And besides, office is an awfully big class. You have to look at the subclass, like medical office. Medical office is one of the most competitive asset classes I've ever tried to do business in, and we got two of them in the last 4 years, and I just love them. You got great big long-term leases. Your doctor is not going remote, and he's not coming to see you, and they have to have places where they do all that build out so that they can serve you properly and serve their patients, and to put those very expensive machines that they have in there. So that's an asset class that is thriving. It's not just okay, it's thriving. But it's part of office. It's not dead. There's my class that I call suburban office, which is sort of, some people call that service retail, and it's, you could argue that it's retail or office, but when I have a retail building, I call it retail, but my service retail, these are offices. Those include like the State Farm agents or the Allstate agents or the mortgage companies or a dentist or whatever. Most of those people are compelled or legally required to have an office. Mortgage company must have an office. They have to hang their license somewhere. Realtors' offices as well, very, very similar. They're required to have offices in most states. And that's where they see their clients. So that's a sector that very much like retail is thriving right now. I just read it for first time yesterday. Retail was also declared dead in 2020. And yesterday I read a report, and it's just, officially in Q2 of this year, retail is now thriving. And I know we bought one in Huntsville in December, and we just put a contract on another one in Spring Hill, and the rental rates are just outrageous on these retail buildings, and it's because nobody built them for 2, maybe 3 years because of the pandemic. Because, oh yeah, by the way, it was dead, and now here they are. They're full. They're getting $30-$35 a square foot, and because it's a pure supply and demand thing, and tenants who now need the space are writing nice long 10-year leases for this kind of product. So anyway, that's my take, and my biggest point that office is not dead is that's too big of a market to declare one thing for the whole market. All markets are local.
That being said, what would you avoid in office? So, like as you said, location is king. So, would you avoid the large metropolitan cities where office, people might have alternates to go to a suburban area to conduct their business? What is not within your buy box?
Well, I would say the downtown areas generally. And the Class A, like I'm from Franklin, Tennessee, and we have a large area south of town called Cool Springs, and there's a sprawling beautiful, office park where, they built 15 or 20 of these 6-story buildings, and they're just pure good old fashioned offices. And it's my understanding a couple of those buildings are struggling in that market. It would be like the Galleria market in northern Atlanta and things like that. And every city's got them. So Class A and anything pretty much downtown city center kind of stuff. But there's an exception. I cover Huntsville, Alabama, which is largely known for being a defense industry center. And there is a large section of offices down there. These are Class A buildings, and they're occupied by big defense contractors. And here's the catch. Almost every single one of those and almost every floor of every one of those buildings, they have this thing called a SCIF. I can't ever remember what that stands for, but it's a secure communications place. And during the pandemic, all of those people were deemed essential employees, and they all went to the office and they all worked in their SCIF. They leave their cell phones outside. There are no communications back and forth, and you can't have a SCIF at home. So would I go buy one of those buildings if the numbers were right? Absolutely. So I'm violating my own rule. Those are Class A buildings, but in general, John, I'm avoiding Class A stuff. But I'm willing to violate my rule or my guideline there for the right deal. So it all comes down to use.
What sort of projected returns would you say investors could typically expect? A range?
Yeah. Generally in our deals, we project going in, and then, currently we're exceeding. People will see IRRs in the neighborhood of 18.5 to 22, or ROIs, in the low 20s. And because all of our deals are cash flow deals, we're not doing development deals where your returns are going to be 60% or anything like that. So we structure every deal to try to eliminate interest rate risk because we use fixed rate debt. We don't have development risk. We try to eliminate it all down to one risk, which is vacancy risk, which is kind of no way to. You're going to have some risks, as you said at the beginning of the program, if you're going to make these kind of returns. If you want no risk, well, then buy a CD or a treasury note or something. But so over time, just generally we calculate out 5 years and project. So just call it 20% IRR, be sort of the middle point, and you're going to get about half of that during the hold period from cash flows, and the other part you're going to get when the property's sold. So we try to refinance them midway through once we've been able to improve or get net operating income up, and refinance and get everybody their cash back as quickly as possible.
We had a good question come in here. And yeah, for those of you listening, you can put questions here in the Q&A or the chat and we'll get to them. What was the worst deal that you've seen, that you've done, I guess, personally? That'd be good to know. And then maybe the worst one that you've seen someone else do in office. And what happened?
Good question. You're as old as I am. You've been through a few wars. So the worst deal I've ever done is a condo rehab in Nashville, where, and I mentioned before, I bought them all up, rehabbed them, and I was doing this in 2007, 2008, and so 72 condominiums. Was gearing up for, we had redone them all. This was a 1968 property, redone them all. I had an average cost in of $52,000, and the market for the 2-bedroom, 2-bath condos in that part of it was about 130. I said, great, how can I lose? And so we had a grand opening weekend. I had 24 ready to go, ready to close on, and we sold 26. And then that was Q1 of 2007. And then, the market was already starting to turn and slow down, and then I didn't sell another unit for 18 months. And so all that interest cost and all that other stuff, it just took all the profit away. Bad deal. I ended up giving some of them back to the bank. We closed every single one of those 26 that we sold on grand opening weekend. But the market just died. The market just completely died. And we weren't structured properly to be able to handle any kind of a downturn. And so that's the worst deal I've ever done. Worst deal I've ever seen done. There's some guys I know, apartment guys, and multifamily is great asset class, but it's only been a few years since we've seen cap rates down in the 3s and 4s, and so I saw somebody go in and buy a property in Nashville that had just been remodeled, and they bought it at a 3.5 cap. I saw their numbers, and they were expecting 12 and 15% rent increases every year for the next 5 years. I'm just like, y'all are crazy. And a year later, they're in the workout with their lender, and because Nashville, to me, I'm sure there's some individual places where I'm wrong, but Nashville has never been that kind of rapid growth kind of a market. Nashville's sort of a steady as she goes market. And we got a shortage of housing units in Nashville, just like pretty much every other city does. But I mean, I could have never put those numbers down on a spreadsheet and presented it to somebody. I mean, that was one of those situations where everything had to go exactly right for that deal to happen. And I've just lived long enough to know that it ain't ever going to happen the way you think it's going to happen. So
I may have probably would have been good to specify this earlier, but maybe we were asking about office. Those are good to know too, but if you could do office.
I've never had an office deal go bad. I've never managed one that went bad. I can tell you about some others like that we've bought, but I have never had an office deal go bad. That doesn't mean that they all go swimmingly, but just being truthful in my own experience. So there's several situations that come up, and where I think a lot of people make mistakes in managing their own offices. So you see this scenario a lot. Doctors will buy the building that they are in, which is not a bad idea, but then they try to manage it like a residential unit. They try to manage it, like an apartment building. But the problem is they do long-term leases, and once you put a long-term lease on any property, you've just put that property in handcuffs. A new buyer can't undo the lease that you did. The lease travels with the property, and generally, the buyer wants the leases. So I can think of 5 properties that we've tried to buy in the last few years that are that same situation. People, they buy the property, they do a beautiful job of maintaining the property and keeping it, but they don't ever raise the rent. Their costs are going up, and they're just so happy that people want to stay. They let them keep the same rent going on 10 or 15 years, and all you've done is devalue your property. Here's some specific numbers. There's one property, it's a medical office building down in Huntsville. They priced it at $5.5 million. And it could have easily been worth $6 with the right leases. And they came to that price, sort of from the single family home approach that, oh, well, we've priced it at this X number of dollars per square foot. That's irrelevant in an office property, because the property is only worth what your net operating income with the cap. You capitalize that. It's only worth what the kind of income you get off of it. And they had just gone through and signed up all their tenants to longer term leases. They had an average lease term of more than 5 years. And at $8-9 below market rents for the area. And so I calculated, and sometimes I still put my CPA hat on and I sit down with the owners and said, now look, this is what it's really worth. I offered them $3.2 million. So they were off more than $2 million, and it's still for sale. That was more than 2 years ago. And interest rates have done what in that period of time? So their property has continued to decline because cap rates have gone up as interest rates have gone up. And so that's what I see most of the time. Sometimes I get those deals. Sometimes it can take a long time. But I advise those people to hang on to their property and wait for those leases to mature, and then tell them to get a listing agent, a professional commercial listing agent, to help them write good leases on there. And then when they do that in a few years from now, that probably be worth $8 million if they price it at market rates. So that's the biggest mistake I generally see in the smaller office buildings.
I was going to ask about best practices in that case. Is it to write shorter term leases, or to write in rent escalation clauses? And also, maybe as a adjunct question, are these triple net leases typically, or are they like double net leases for office?
Generally, what you see in most office spaces are a modified gross leases. So it's sort of a base rent plus utilities. Most people have gone to the cost of making people of each unit being separately metered, and that in the modified gross will include some modicum of CAM bill back, or at least it's an increase in operating cost from their base year of rent. It can get a little complicated, especially if you got multiple leases and they all got different base years and whatnot. However, I'll say the South is finally picking up on a trend that I think began up north, and where you've got office properties going full triple net. From an owner perspective, it's a beautiful thing. And so you get base rent. If you don't put in a rent escalator, you're devaluing your property, because I mean, even if inflation is near zero, the way it was for 20 years before 2021, your property is still worth more, and it's worth more to the tenant to be in your location. So you need some sort of a rent escalator. And so that's where a lot of the non-professional landlords make the mistake. Even during the 20 years from say 2010 to 2020, people were migrating down to 2% escalators, on the annual, which is okay. It's better than a stick in the eye. But these days it's 3s and 4s and 5% escalators, and plus the operating costs are being billed, nearly 100% back to the tenants on top of it. So when you've got that kind of lease structure, going back to your first question, you try to get as long of a lease as you can. What was really interesting was during 2020, and we were managing some properties, and rightfully so, none of us knew anything about what was going to happen. And said, well, I got a renewal. Can I do a year? Can I do 2 years? And we're like, if you'll stay, yes. And we were just glad to have them. But shorter term leases do generally require a higher rate per foot. And so you make more money on the shorter term commitment. And then, you let them renew for 2 years. And then after that, so now it's 2022, and now they want to do another 3 or a 5-year lease. And now you're benching off of, that short-term boost in rents, and the whole market is supporting you because everybody sort of went through the same thing. And now rents that in 2019, I was renting for $19 a foot. I'm now renting for 26. and that's supported by the market in general, and a little bit of push down from Nashville in the north and stuff like that. So in a way, the pandemic, which forced people into shorter terms, has actually made everybody pay more, even on their longer term deals. So it's been unbelievably beneficial. So.
Definitely not something you hear often. The words
No.
it's been when you're talking about the pandemic and the office market.
Yeah.
So we have a lot of passive potentially passive investors in the audience. What should they be considering when they think about office and investing in office, either individually or more often is the case like with some type of syndicate or operator?
Yeah. What I tell every passive investor, even our investors, is you may not be responsible or in position to underwrite the deal, but you can underwrite your sponsor. You make sure you know who they are, find out how many deals they've taken full turn, ask them the questions that I've been asking you. What's the dumbest mistake you've ever made, or whatever, and see if you get honest answers. Because if they've been in the business 10 years or more, they have to have made a mistake, and they ought to be proud that they're still around to be able to tell you about the mistake. So because we're all human, we all make mistakes. So do all the due diligence you can on the sponsor. And then you go back to rule number one, which is check into the location. Because there's so much of the deal that you're just going to have to take on faith as passive. There's not as much as you might think, but make sure that you think that the location is perfect. And I think this goes into whether it's a multifamily deal or an office deal or whatever. There's probably some markets in this country that I wouldn't dream of doing office deals. But there's an awful lot of them that I would. We're negotiating on one down in Florida as well, which is a market that we're getting to know as well. And it's full, and it's another doctor-owned building. And so there's a lot of deferred maintenance and so the short term on that one, after we go and do, some facelift stuff, easy stuff, we'll be able to get rents up $3-4 a foot, per year on that one with the same tenants that are already there. So anyway, just do your own analysis on the location, but absolutely do your due diligence on the sponsor.
Out of curiosity, is your personal portfolio? And again, just like from a passive investor perspective, when we're thinking about how do we allocate our portfolio into different asset classes, is your entire portfolio in office, like some of it in multifamily? What does that split?
We like office. We got 2 office buildings, retail building that we bought last December. We have a major position in storage, which we love, which correlates very well to multifamily. We're very proud of that one, and we're about to do an expansion, which was always part of the plan. So we are not like other sponsors, and I'm not saying they're wrong. We focus on our geography, on our southern Middle Tennessee and northern Alabama area that were born in, grew up in, lived in. It's just what I know. And since we manage, we want to be within an hour of every property. But so we spread it out among the asset classes pretty well. I'm doing another medical office building in Birmingham, which will probably close end of July. And we just put an LOI on another retail building not far from our office building in Spring Hill. Again, I think retail is the hottest class of the year so far, and it's fascinating. We're in the middle of this 15-year shortage of housing units, and multifamily is struggling a bit. And it's mainly due to financing and things like that. It's not due to lack of demand for the units. It's a financing thing, but retail, small retail, is absolutely blowing the doors off in many markets around the country.
Where would you rank those three asset classes you mentioned, office, self-storage, and retail, in terms of like, I love this one the most, middle child and the least?
So just on personal preference, sometimes it depends on the day. I mean, managing storage is a retail business, and that's okay. You just got to have good rules and you just hold people to them. But it can have demands, at odd times of the day. If the gate breaks at 10 o'clock, and this stuff doesn't happen much, but if the gate breaks at 10 o'clock at night, and the computer won't respond where I can log into it, well, then you got to go down there and pull the gearbox and unlock the gate. So it can be a bit, like I say, retail. I think my favorite would be medical office, and that has to do with the long-term stickiness of the tenants, the very long-term leases. I mean, a short medical lease is usually about 10 years, and because they're putting hundreds of thousands of dollars into their build out. And so if you keep the common bathrooms clean and you vacuum the carpets and which is all stuff it's very easy to farm out to vendors, they're happy. And frankly, you very rarely hear from them. And I got tenants I try to build relationships. Some of them don't want relationships. They just want the place clean. So I think of ease of management as well as a very fine return on investment. A medical office is probably about as good as you're going to get. Operating cash flow wise, storage all day long, and it can be fun. And cap rates will move up and down, and so one day we'll sell storage when the cap rates are down, and we'll do quite well with that one. But right now we're throwing off 8% cash on cash and growing every quarter. So.
Do you find that you use an employer CPA either from a tax perspective, to generate kind of efficiencies or best practices in these investments? I remember when going through school, I had a CPA. I was an accounting major as well, CPA professor, and that's a lot of what he talked about. Like, how do you, both for residential as well as for commercial, like how do you think from a CPA's perspective on
I do
on tax efficiencies?
Yeah, I also see the marketing side of things. And again, that comes from that entrepreneurial vein that I've got in me. But I mean, I'm a numbers guy. I'm a open and admitted numbers geek, which is really what drew me to real estate in the first place. Because a property is a property is a property. They all basically got rent income of some kind, and they all have the same 4 or 5 basic categories of expenses. Management, maintenance, insurance, taxes, and a little bit of administrative. So it's very easy to compare one property to another. And perhaps that's oversimplification, but and when you're a real asset class expert, you'll look at a 300-door property and wonder why the electric bill is more per door than anything else. So and that's appropriate too. But as a CPA, yes, I do think about efficiencies, and everything is structured to be as tax efficient as possible. We're doing cost segregation deals on every asset that we do. That's sort of pro forma for everybody these days. And when you're trying to find a great tax deal, well, you should gravitate over to storage, because virtually every piece of that building above ground is can be classified as personal property. You're going to get a very high percentage of that asset purchase price reclassified as personal property. Less so in office and more so in multifamily. Multifamily, you got a high percentage as personal property. And again, less so in office. but your overall cash flow over time, I think, will tend to be your operating cost will tend to be lower in most offices than average multifamily. Multifamily is a high volume kind of a business. You're going to be turning those, it's like the original subscription business, and you can very easily apply the subscription metrics, so lifetime value and cost per acquisition and stuff like that. You can apply that to the multifamily world, and it's appropriate. The multifamily is high volume. I think y'all correct me if I'm wrong, but your average tenant stays there about 2.1 years or something like that, depending on whether it's A, B, or C type properties, and there's costs every time they turn over. So so I don't know if I answered your question. So
Yes.
from a pure cash on cash, it's going to be storage. From an ease of management and as well as a great return on investment, it's going to be office. So, but I might change my mind later if retail keeps going out of control the way it has been. So
That's interesting on retail. Is that primarily because it's post-COVID, retail got demolished, and like now everyone's getting back into retail?
yeah, I think there was a 2 to 3 year period of nobody developing any new retail properties. A lot of projects got stalled and whatnot. So now there's no inventory in the market, and you go into these suburbs of places like Nashville, which has been growing like crazy for 10 or 15 years, and Huntsville's the same way. So you keep going out into these, you've got 5,000 homes and no place to get pizza, and so people put one up, and next thing you know, they're getting $40 a foot, for a pizza joint. In this one we're looking at, there's a freaking dog groomer that's going to be paying $38 a foot. I'm like, how many dogs you got to do? You have to clean to get that, but they've been in the business for a long time, and so I'm not worried about that lease.
People love their pets.
People love their. Yeah, this is a very high end place in Middle Tennessee, and so yes, they really love their pets. So,
How did you see the office landscape kind of shift after COVID? Was it mostly just people leaving like the downtown areas, and like the suburbs stayed relatively the same? Like, how did that impact how you saw that asset class?
I think that certainly helped the properties that we've acquired. At least in this sort of central south area, even before the pandemic, in the statistics sort of supported in 2019. After 15 years of people moving to the downtown areas, that had started to shift. People were already moving back out. COVID, like a lot of things, like hybrid work, accelerated a lot of trends. And certainly people didn't want to drive downtown anymore just to sit at a desk and see their coworkers who they could see every day on their computer screens. And so having properties closer to home, maybe a 3 to 5 mile commute versus a 30-mile commute, obviously is a benefit. We've benefited from a lot of that. We've seen some companies like big home health companies, they started putting out regional offices all around Nashville, 20, 30 miles out. And so they went from having 2 floors of a Class A building to having 20 or so 2,000 square foot offices, to have regional centers and things like that. And we've picked up a couple of those type leases. So yeah, I think it was a trend that was happening, but was accelerated by COVID, and pretty much people need to just meet when they need to be face to face. And there's Zoom is great, but sometimes you all got to be in the same room together. So.
And like going forward, what kind of trends are you seeing now that we're coming out of this? We're well into this post-pandemic world for office.
I think the employers will ultimately win the office battle, and you know you can find plenty of stories, and we all know. So they're telling people the hybrid model is here to stay. I think that's a settled issue for most employers, um, and therefore they're going to have office space. They may or may not need as much as they had, but they're going to have office space, um, and people are going to work from home, probably a lot of Fridays and stuff like that. So it's a different world. I think many employers will step down their footprint, but that's a whole lot different than eliminating their office footprint. Big employers who've come to the Nashville area, Oracle, Alliance Bernstein, Google, WeWork, who in the middle of 2020, I think increased 3 times the amount of office locations they had in Nashville, and have sort of maintained. People love that kind of come and go type co-working movement. Frankly, in my opinion, some of the spaces that are going to get reduced when employers have the chance to reduce, I think a lot of that's going to get sucked up by co-working. So I think that industry is going to tend to explode. And the big names in that, Regis and WeWork, I think that they will do well.
Gotcha. Well, with that, we have a few minutes left, so we'll round out with some of the questions that we like to ask every guest that we bring on. So we already actually talked about some of the failures that you had. What did you learn from the condo experience that you discussed?
Yeah, I would say even broader, what I learned through going through the whole great financial crisis is you don't know what you don't know. From my world, I went from a period where banks were agreeing to my next deal over the phone without a great deal of effort to hey, by the way, I need you to pay all those loans back. In about a 5-month period. In 2008, 2009, and you don't know what you don't know. Your bank is not your partner, and you really can't take on these kind of projects without having reserves. And because I had acquired a great deal of property doing what some people call the equity ladder. I'd buy this property, wait a year and a half, refinance it, buy something else with the equity, and I probably did that half a dozen times and amassed a great deal of property. And it's kind of like the other guy I was talking about. I did all that with hardly any of my own cash in it, because what do you need equity for? Everything's just going to keep going up, right? And banks were easy, and all you had to do is ask. They didn't even make you fill out the application anymore. Just show up at closing and get a check. So, and the world changed. So I've become an evangelist for reserves, and we build reserves into every one of our deals. Generally, we go for 12-month reserves. If we're worried about any of the tenants, we might like the property, but there might be one tenant we're concerned about. We might add a few more reserves, which does depress our returns because we're collecting in cash. This, hopefully, if everything goes right, is just going to sit there for 2 or 3 years. But and in my other 2020 hindsight, you don't need years of reserves. You probably need 6 to 8 months of reserves. So we've just opted for 12, and it's just a smart, safe way to be. But again, you don't know what you don't know. We don't know what's going to, we don't know everything that the Fed knows about why they haven't lowered interest rates yet. I think the Fed thinks that there's a crash coming in the labor market. I've even read stories. I think the Fed thinks that we've got some more bank failures coming in Q3. And so I hope they know more than us. That's sort of what their purpose is. So we don't know what we don't know. So you got to be prepared. And the sort of flip side of that is, to me, the key to investing is, and there's a difference between investing and development. I'm not knocking anybody who does development. No, those are the risk takers. God bless them. But when you're investing, you need to look at it with a long-term picture. And to us, it's all about cash flow. You buy stabilized assets that are going to throw off increasing amounts of cash flow year over year. You maintain the property properly so that you can justify those increasing rents. And once you have enough of a foundation in cash flowing assets, well, that gives you a license or the right or the comfort to go do a development deal or invest in an IPO or whatever. So cash flow as a foundation of everybody's portfolio is kind of what I preach, and that came out of my learning. So,
what are a few ways that you give back to your community?
I do an awful lot of work with not-for-profits, and particularly one that's targeted at crisis intervention with teens and young adults. That one's very near and dear to my heart. I am their CFO and help them maintain a good financial balance. And it's a fairly old ministry, but they've been through their own ups and downs, and I'm proud to say I've helped them to navigate them through some ups and downs of their of recent years. Because we can talk about financial ups and downs. Well, usually your not-for-profit is not doing so well during that time either, because donors are much like investors. They tend to hold on to their money. So that's one of my favorite ways, and I also work with the youth at our church and things of that nature.
That's great to hear. And what are the best ways for those listening at home who want to reach out to you? What's the best way? So,
the easiest way to get in touch with me or reach out to me is go to harvardgrace.com and poke around, get some free resources. It'll cost you your email address, which you can immediately unsubscribe from. But get all the free resources. There's one out there that I think passive investors might enjoy. It's questions you should be asking your passive investment sponsor. And I sort of alluded to that. There's all other kinds of resources out there for free videos, and then navigate over to contact me. You'll find my Calendly link out there, and I sincerely invite anybody who wants to chat, book some time with me. I can talk about real estate pretty much anytime, any day. If I'm available, be happy to chat with you. So I encourage anybody who's interested to reach out.
Great. Well, thank you very much for the great talk, Stewart, on why the commercial office is not dead.
Pleasure to be here. Thank you very much for having me.
Yeah. So for those of you who are interested in learning more about the office market or the other topics Stewart mentioned, feel free to reach out at the website he mentioned. We'll include it in the link, when we upload it as well to the various podcasting platforms and YouTube. Thanks again for teaching us about the office market and why we should take a second look at it. And for listening at home, don't forget to like and subscribe to our podcast on whatever platform you're listening to make sure that we can continue delivering you the best educational content. Thanks, everyone. And until next time, keep learning to invest for generational wealth.